Thank you, Gary, and good morning, everyone. Thanks for joining us on this beautiful Wednesday here in the Midwest. I think it's supposed to be around 80 degrees, so thanks for staying inside and watching this presentation. How we're going to start out is just ask you a question. What do you know about your contracts? Because in our world, all contracts do matter. We're talking core, debit card, digital channel, item processing, imaging, whatever you have, they all matter when it comes to contract negotiation. If you don't have the contracts at your disposal, if you don't know where they're at, ask your account manager, call any management at the company you're working with and get those actual contracts. When we start working with clients, some of the first things we look for are original contract dates on the contract when you sign them, any addendums that attach to that contract, and then of course auto renewal terms. If you're going through your contract and all of a sudden you miss that date, how long is it going to renew for? And then of course, non-renewal terms. What is that date? You have to let that company know that you're not going to renew that contract, that you're going to look at negotiating it, or worst case scenario, looking at leaving that vendor and going somewhere else. All right, for the next 20 minutes, we're going to go through a few scenarios. We feel that's the best way to relay our point and that these contracts do matter in valuing your bank. This first bank, 100 million in assets. It's been on vendor A for a long time. Very typical for the clients we work with. They're happy with the software. They trust their vendor. They trust their account manager, and they just really get really good service from them and are happy with what they have. Continuously added products over the time of their contract, adding digital banking, adding mobile banking, things like that, business banking, etc. The debit card provider has been there since day one. They're not interested in changing it, haven't looked elsewhere. They have not looked at other vendors, just happy with where they're at. And they've never questioned the contracts. They don't get outside help for review. They don't bring in outside consultants to help with negotiation. They just work with their account manager and their vendor to move forward and sign the contract and move on.
Yeah, this scenario is also very common that we were brought in to help. The bank already had a very good relationship with their core technology vendor and was open to evaluating the vendor's ancillary products and services. Debit, credit cards, online, mobile, item processing, check imaging, document imaging, etc. Though the bank had a good relationship with the vendor, they still felt the need our help to make sure all of the wrapper products and solutions were going to meet their strategic needs. We helped the client also look at alternative vendors in an efficient and value-driven manner, and we compared all aspects of the ancillary products and services to make sure the needs of the bank were being met. We analyzed all of the pricing scenarios, including growth over the proposed term of the new agreement. And in this scenario, the bank ultimately decided to stay with their current vendor and add more of their products and services. After many meetings with the bank's senior leadership, it was important to make sure we protect the banks in the case of a future acquisition. But in addition, we also added language in their agreement if they became an acquirer. And though they felt that this was less probable, we still felt, and the bank felt, that this was important to give our client options. To fully protect the bank, many aspects of the contract were reviewed and negotiated, specifically around deconversion fees, caps for each product and service were identified and negotiated tough, but fair with the vendors. The vendors clearly don't like having these locked in, but it's imperative to always protect our clients' interests. Liquidated damages, languages, and early termination fees, reducing the percentages in these areas significantly reduces the penalties for canceling their contractual commitments before the stated contract expiration terms, which also gives our client more options when considering an appropriate acquirer.
Now, along comes the spring and early summer of 2020. We all know it's been a crazy, difficult year. The bank ownership decides to sell this bank. They wanted to move south and retire and get out of banking altogether. They come up with a plan to sell the bank, and they bring in outside help, like Eide Bailey, to help them, prepare for a sale. The firm handling the sale reviewed the contracts and came up with a few red flags. The main thing that they noticed was that the contracts did not match up at all, and it was some of their major products. They also noticed that the early termination clause did not credit time with the vendor. So the last couple of years of their contract, it wasn't a reduced rate. It was a full 100% of what they owed that vendor. This included over $130,000 in incentive payments. It was if they ended that contract early, they had to pay the full amount back, no matter how much time on that contract. And then with this, by reviewing the contracts and analyzing their current invoices, they calculated the fees that were owed to those vendors. The slide breaks down for the calculation for each vendor, and you can see how it adds up quickly when they're not matched up. But when you add these together, you see the deconversion fees, you see the incentives. The fees calculated for this client are over $1 million. Now, that is before working with those vendors and actually asking them if they can reduce the fees, or depending on the buyer. But these are what's in the contract, and really nothing else is guaranteed except for what's in writing in those contracts.
So bank two, in this scenario, a typical scenario, right? The bank ownership has always had a friendly rivalry with a nearby institution. They share many of the same values and commitment to their community. And with the current regulatory environment and competitive challenges, now made more sense than ever to explore the opportunity to merge the banks together and create more value for their respective markets. So when we take a look at Bank 2 versus Bank 1, here are the similarities. Same estimated deconversion date, same asset size of an organization, same monthly fees around $18,500 a month, using very similar products and services, the same totaled incentive credit of $130,000, similar termination dates for key vendor contracts. Now, when we compare the differences, with the bank planning ahead and requesting our help, all existing products and services agreements were made coterminous. We were also able to negotiate all liquidated damages and early termination fees. As well, we successfully negotiated the clawback amortization for the upfront incentive credits. And last, we negotiated the deconversion caps for all product lines and service schedules. The results are a total vendor payout of only around $414,000 for early termination for all existing agreements, which is significantly more beneficial to protecting shareholders' value when compared to Bank 1, with a vendor payout of over $1 million.
While everybody's answering that, back in the day when Tom and I sold core software, every time we had meetings, Tom would be called to the carpet, because when he'd sign a new client, he would actually have them sign a non-renewal notice the day after they signed their contract. And management always asked him, why would you do that? Well, it's because it was the right thing to do for the client. This way, you don't have to sit there and manage the 180-day non-renewal date, or 60-day or 90-day, whatever it was. You just know that vendor, that account manager would come to you and say, hey, your renewal is coming up. We need to start working on this. How can we help you, and how can we sign you for an extension and staying with our vendor? We haven't heard about anybody doing that. In the last 5 years we've been doing this. We feel that non-renewal notice should be done sooner than later. And as Tom alluded to, on the differences and the likenesses of these two banks, it really is apples to oranges. Bank one did not plan ahead. They didn't ask those hard questions if they were going to sell, if they were going to acquire, if they're happy with the software, need to look elsewhere. They were surprised by contents of their contracts. If you look back at and you guys can request a copy of this slide presentation if you'd like. If you look back at the calculation, the deconversion fees were crazy high compared to Bank Two. They did not know their contracts were staggered. Their total fees owed to the vendors were way higher than expected. They just didn't think that, they'd be paying the full value of their monthly fees to those vendors. And when we get to Bank Two, they did plan ahead. They acquired help in selection review process. They had help with their contract negotiation. Everything was coterminous and negotiated, and especially those main terms and condition of the contract. So when you're looking this apples to oranges, it's a difference of over $600,000, and it was really like scenarios for both banks.
Yeah, Mike, and also we want to be real clear that as we've been discussing how contract terms and renewals create problems for our clients. I mean, these are created by the vendors, right? We want to be very clear that we are not advocating that all of our clients need to move away from a best of breed model to a single source provider model to achieve maximum results. The de novo bank that I started back in 1999, we were a complete best of breed model. But we just want to be real clear that we're not advocating for that, just because you might only have one major service provider that is providing almost every product and service, we find more times than not, every single contract, whether it's for mobile, for debit, for item processing, they all have differing expirations, renewal terms, cancellation notifications. So just because you might not have a lot of vendors, don't assume that your vendor agreements are all lined up properly. And unfortunately, Mike and I have been on the other side of the table that the vendors are trained to create this contractual chaos and turmoil to minimize margin compression. So we want to make sure that at the end of the day, we're protecting our clients and giving them as many options as possible to consider the most value-driven M&A partner to ensure not only happy clients, but also a happy staff.
Right, and those staggering contract dates, that's another thing that these vendors are trained to do. They have sessions on it. I won't say which one of us were at a company that, no matter what the size of the agreement was, it had to have a 5-year term, and you were not to tell the client that it was a 5-year term. So we really advocate and looking at every contract with a fine-tooth comb, make sure it's added on and a coterminous date to your other contracts. Otherwise, even though it's a small contract, it still adds up to those early termination fees. And like Tom said, it's more of a hassle and more of a crazy scenario when you're trying to figure out what fees you owe and what contracts you have.
Okay, thanks, Mike. Thanks, Tom. This is John Fisher now, and what I'll lead into is when we get to that decision, or your bank gets to the decision to sell, and how does that play into the vendor contract review process. And the first thing I'll say is, 95% of you will not be for sale in the next 2 to 3 years. So the vendor review process is really something that I would advocate for you to be doing all along, just to improve your operations and your profit. It's a good business practice. But when we get to the decision to sell, we hope that this review process is started 3 to 5 years before that decision. And while it's probably not always true, but that's what we hope for. You want to get those contracts to be coterminous. You want to make sure that you've negotiated those terms. And therefore, you want to do this as part of your strategic planning process, as I mentioned. You want to be more like Bank Two when you get there than Bank One, obviously. Bank One, with a fee of over $1 million, we've seen some deals come to a halt because the seller wasn't aware. that they had those kind of fees sitting out there, and they just decided to hold off for a year or two and utilize those fees. So we want to make sure our banks are in a position that they know exactly where they're at. But let's say we didn't have that option. We're down to 6 months, and then how does the vendor review process help us? And as a seller, it still can. While the benefit may not be as substantial, it's still important that you as a seller know exactly what those terms are, so you can be upfront in your discussions with your potential buyers. It's part of your process to prepare your bank for sale, whether when you go through and you prepare your loans and your securities, your other real estate, all your other assets, you want to make sure you have a good feel for an understanding of your vendor contracts. You possibly can negotiate these contracts with your vendors, but it's doubtful, but you still might be able to find some value. On the buy side, when is it important? Well, it's still very important to have those contracts reviewed. When you come in as a buyer to look at a potential target, part of the due diligence process will definitely be to review the contracts that you're assuming. If it's a merger or a stock deal, you got to know what you're buying. You want to fully analyze those and negotiate with the seller or the vendor if you can utilize some of those contracts. You potentially have a higher bid if you can use some of the contracts, but you have to fully understand them. And what we like to say is when you're doing due diligence on a buy, you have your loan officers look at the loans, you have your other people look at securities, you have your CPA firms look at the tax accounts, review the structure and all that. And we really advocate for having somebody familiar with vendor contracts, review those contracts so you know exactly what you're buying. So we just want to make sure we're utilizing that. And with that, I'd like to thank Mike and Tom for their information today. And if there's any questions, I do see one. While the banking environment changes, it seems like the big three core vendors are major hurdles in allowing banks to innovate and partner with fintech companies looking to provide better users and product. How have you seen leading edge banks overcome this hurdle with traditional core vendors and are moving to open core solutions? Tom or Mike, is that something we can answer now, or should we answer that to the person questioning that?
Tom, I think we can handle that really quick. We have been seeing and hearing it more. I would say I don't believe the big three are against the fintech. I think what they want to do is really make sure that that bank and that client understands the role of the fintech and their dedication to it, and it's not just one-off scenarios. We have a large client in Iowa that is a very big player in fintech. They haven't changed their solutions in 20 years, 15 years. They're a best of breed shop. They found some solutions that work for them. There's other vendors, there's other clients that have gone all in with a provider that says, hey, we have a tool that these fintechs can join up to. But I would say, it's a tough answer, but it depends. It really depends on the client, and it depends on what they're trying to do with that fintech. But we've seen it all across the board, small banks, large banks, dedicated to the fintech.
Yeah, I would add to that, Mike, that what we've also seen is that the digital and the payments channel is really leading on these big three. Mike and I were with a bank in Alabama years ago, and we had some of the major head executives from one of the major players out there. And you could almost not even find the word core on their heat sheet when they were talking about all the things that they were focused on in the next 5 to 10 years. And so we've seen a lot of talent that these big, the core vendors have brought in, because that has been a struggle, is that typically that's where the third-party ancillary systems have used that against the big core products and solutions, is that their ancillary products aren't keeping up. And they have brought in a lot of talent on the digital and the payments channel. Now it's not to say that the other third-party ancillary systems aren't fantastic and they don't meet your strategic needs. And that's where we come in to be able to help out and vet those strategic objectives to make sure they're meeting your bank's organization.
Okay, thank you. We have one more question, and if we can just take a minute or two to answer this one yet. A bank has signed their contracts a year ago. Is there anything that they can do now or they need to do to wait until we are closer to expiration date?
Uh, Great question. There's a lot of things happening right now where vendors are actually coming to clients that signed contracts just a few years ago or even last year to sign a renewal, an extension. As our clients have seen, the last 6-12 months have been tough. Well, these big vendors and all vendors have seen the same thing. There's less churn, which is a bank turning from one core to another. There's less addition of products. There's just less buying by banks because you're dedicated to PPP and you're dedicated to making sure your bank and your staff are healthy, and of course things in the community. So we seen it just last week where unsolicited, one of our clients was sent an extension offer, and we're reviewing it for them. We're looking at it. There's never a bad time. If you feel that you need to have it looked at, we can look at it. Other people can help, but it's a good time to review those contracts and really set that up to help for your strategic plan for your bank.
Yeah, and I would say as a former senior lender that if we had a strategic customer and clients, which we had a lot, our top 20% represented 80% of our profits. And so we made sure to take care of that top 20%, that if we needed to get in there early and do some type of a modification extension agreement, whether it was a line of credit or refinancing their building to make sure that some of the bigger regional and super regional players and national players couldn't take that client away from us. We're actually now seeing that right now with the vendors, that they understand that their margins are being compressed and their shareholders expect that stock, if they're publicly traded companies, to see that that stock price continue to go up. So we're in some unprecedented times, but absolutely we're welcome to have that conversation.